Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three top stocks to consider buying in July for the second half of 2023. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these three stocks to consider buying as we start July next week and kick off the second half of 2023, let's just kind of wrap through the market to give a better sense of what's going on. So we had a pretty boring 2-day stretch on Wednesday and Thursday that might have led many to believe, including myself, that we might see a quiet Friday leading into the 4th of July, as many people were probably taking off Friday and Monday to take those extended vacations. Instead, through morning trading on Friday, we didn't see a boring day. We're having more of a bullish crescendo into the final day of trading in June. So the NASDAQ was up about 1.4% the last time I looked, with the S&P 500 up 1% as of this recording. So Wall Street remains upbeat as more economic data continues to showcase the strength of the U.S. economy. The big updates Thursday were revised GDP figures came in far better than expected, and jobless claims were lower once again. So the U.S. economy remains really strong. Obviously, then we saw the comments from Powell again yesterday as he continues to just say the inflation fight is not over, but that's nothing new. Powell's going to be the last to come out and say the inflation fight's over. He's not going to declare victory until maybe 10 years from now or something like that. Obviously, that's a joke, but Wall Street's comfortable enough with the idea that the Fed's at least going to only raise maybe a few more times, and they're at the tail end of their rate hikes, with the eventual pivot coming possibly in early 2024. Obviously, the economy still remains strong, so Wall Street's banking more on a soft landing with interest rates kind of remaining higher for longer. But that's okay, as they kind of bake in the economy getting back to normalization after this insane COVID disruption. So the labor market's normalizing, supply chains are normalizing, credit markets are normalizing, and things are hopefully just getting back to more just stable levels after the just insanity of the last several years with COVID. And we're, as we said, we're ending the first half of 2023 on a really bullish note. So with this in mind, we're going to take a look at these three highly ranked Zacks stocks. And the first one of these stocks today is Cadence Design Systems, which trades under the ticker CDNS. So Cadence's modeling and computational software helps in the design of semiconductors and much more. It's a leader in electronic systems design, with its intelligent systems design strategy helping deliver software, hardware, and IP that, quote, turn design concepts into reality. So Cadence's offerings help in the creation of the backbone of the modern economy, which are semiconductors, as well as complete systems for things such as hyperscale computing, 5G communication, automotive, mobile, aerospace, consumer, and industrial sectors, so various systems within there. So beyond just semiconductors, but semiconductors may be what it's most well known for. Cadence boasts NVIDIA as a key customer because the GPU giant loves its simulation capabilities. Cadence is one of two really major players in this key realm that semiconductor companies and many others need to use to bring their ideas to life. Its offerings might be even more important as NVIDIA and everyone else in the chip space race to the sub 5 nanometer and below, and possibly far beyond that in the years to come. So this means that Cadence is also an AI play as well. So it's intelligent system design, and its tagline overall, just to give a sense of what the business is, it's pretty straightforward. And obviously all these companies have very complex things. If you're not a real tech engineer or something like that, their basic tagline is unleash your imagination and turn great ideas into reality. So that's the pitch for their business, and why all of these companies from NVIDIA and beyond turn to them before they actually manufacture their products. Their revenue growth has been pretty stable and impressive over the last decade. They did about 10% growth in 2018, 9% growth in 2019, 15% growth in 2020, 11% growth in 2021, and then they did 19% growth in 2022. and its growth is poised to keep going. As I said, they're going to remain a key player in chips and beyond. We're calling for another 14% growth in 2023 and then another 10% growth on the top line in 2024 to get up to about $4.4 billion. And then on the bottom line, we're calling for 17% adjusted earnings growth this year and then another 12% adjusted earnings growth next year. And overall, the company's adjusted earnings estimates have continued to trend higher and higher and higher, especially since the start of 2020, as more and more companies are turning to their offerings as things get smaller and smaller and more complex. Its estimates for 2023 are up significantly over the last year. They're up 14% from where they were this time last year. So they continue to improve their outlook, even though many of the broader tech industry has seen their estimates for 2023 kind of decline since this time last year. Cadence has seen that go in the opposite direction. So these positive revisions help it land a Zacks rank number 2 buy at the moment. Now we'll move on to the stock price. The stock's up about 1,400% in the last 10 years versus tech's 260% run. It's up 430% in the last 5 years versus tech's 85%, and it's up 45% year to date. It hit new highs in mid-June, and it just bounced back above its 21-day moving average, so that shorter dated moving average. And in terms of RSI levels, another technical thing people like to look at, it's kind of floated around these overbought RSI levels on its historic time frame for most of the last 5-6 years. So it kind of floats in or out of that overbought range. So it's a stock that people have just been willing to pay up for. We'll see that in the valuation as Wall Street understands that its efforts are really crucial to such a key space of the economy. And also, as I probably haven't mentioned, it does something like 40% margins consistently, so really high margin business as well. It's currently trading at 53 times forward earnings, but that is a 26% discount to its own highs, even though its stock price is right near its highs. And then if you look at its PEG ratio, which factors in growth, it's trading at 2.8 right now, which is a 52% discount to its highs and 7% below its own 10-year median. So despite its massive run, if you factor in its growth, its valuation is pretty impressive at the moment. And overall, in terms of Wall Street, of the 12 brokerage recommendations Zacks has at the moment, 9 are strong buys with 1 at a buy and then only 2 holds, so no sells here at the moment. So overall, Cadence certainly worth considering at the moment. Maybe some people want to wait for it to heat up or cool down, but as the first half is showing us, exact market timing is very difficult, so most people just want to stay exposed. If you have a long-term investment horizon of, say, a couple of years or even more. I mean, if you have a decade to consider trading or investing, you don't need to worry about, this price is maybe 10% too high at the moment. So that's just something to always keep in the back of your mind. And as we saw in the first half, it's kind of hard to play those levels and try to get in at the exact right time because a lot of people weren't calling for this big comeback. And now we're going to take a look at another stock that's in a highly ranked that's a highly ranked Zacks stock, but it's in a very different industry, and that's Lululemon. The company topped our Q1 earnings and sales estimates on June 1st, with the stock up about 13% since that report, yet it still trades way below its all-time high. So we're going to get right into Lululemon, which trades in the ticker LULU. So Lululemon first made waves in the apparel world through its expensive women's yoga apparel, which is still a big part of its business, but the company has kind of evolved into a well-rounded sportswear and apparel company that helped transform the way lots of people dress, and lots of other companies have evolved to kind of adapt to Lululemon style. They sell now everything from women and men's clothing that you can wear to the gym, the office, a date, the golf course, practically anywhere. They still sell a lot of leggings and athletic shorts and workout gear, but they also sell everyday pants and shirts and tops and outerwear and jackets. And they've moved into self-care, things like that. They've in women's footwear. They now have their own resale shop where you can buy and sell used Lululemon apparel. That's something that's rather common in these spaces with these loyal customer bases. Patagonia, places like that have their own resale shop. So it just shows how much people are in love with the brand. They have great brand loyalty. And companies from Nike and beyond have all kind of raced to keep up with Lululemon in this space in terms of being on trend at all times. Their growth is really out of this world, and we'll get into the fact that their prices are really high, so their customers tend to not be as engaged with maybe if the economy is fading or anything like that. They're able to continue to raise their prices and not see their customers run away. So their growth is really nuts. So last year in their fiscal 2022, they did about 30% revenue growth. The year before that, they did 42% revenue growth. Before that, they did 11, 21, 24, 13. You get the picture. Just really impressive top line growth. And then they recently reported on June 1st their first quarter fiscal 2023 results. They're on a little bit different of a calendar year, but their revenue increased 24%. And then their revenue in North America increased 17%. With their growth 60% internationally. So it's good to see them growing outside of North America, where they had traditionally done a lot of their business. Their comparable sales were up 14%, so really impressive. And their direct-to-consumer net revenue was up 16%. So growth, really solid growth across the board. And their gross profit increased 32%. And their gross margin increased by 360 basis points to about 58%. So really impressive stuff right there in their last quarter, which is why the stock is up over 13% since they reported. We should also note that the company opened 7 net new stores. So they closed their first quarter with 662 stores, and they're trying to expand outside of North America into various other places in Europe and Asia. The company also said they remain on track to deliver on their Power of 3x2 growth plan. That's their language. But their growth idea is really pretty staggering. It helps showcase just how much they're prepared to continue to grow. So they're calling for the doubling of the business from 2021 revenues of $6.25 billion to $12.5 billion by 2026, with the key pillars of that being product innovation, guest experience, market expansion. They plan to double their men's business and double their direct-to-consumer business and quadruple their international net revenue relative to 2021. So it just shows the rapid pace of growth that Lululemon is doing. So with this in mind, we're calling for another 17% revenue growth all the way up to about $9.5 billion this year, and then another 13% next year to get up to about 10.7. And then on the bottom line, we're calling for 18% adjusted earnings growth, and then another 16% adjusted earnings growth next year. And the company has seen its earnings revisions trend higher since its report, so that helps it grab a Zacks rank number 2 buy at the moment. So both its current year and next year's consensus earning estimates have climbed since that last report. And then, as I mentioned, they just run a really high margin business. If you don't know anything about Lululemon, their clothes are pretty expensive. They sell things like $90 shorts and $120 leggings. So that did help them continue to grow, even though the economy has been sort of strange in the post-COVID boom come down as inflation's been really high. People have had to take a step back, but Lululemon, as you can see from their growth, has not really felt the effects of any of the slowing consumer spending. So in terms of the stock price, the stock's up about 500% in the last 10 years, 200% in the last 5 years. This includes a lot of sideways movement in the last 3 years, though, so maybe the stock's eventually going to be poised to break out. It's trading over 20% below its all-time highs, even though it's up 17% year to date, which includes some big swings. We just saw it bounce up back above its 21-day moving average. So investors might want to consider getting into Lululemon well above or well below its all-time highs. And it's kind of chopped around for the last several years. So maybe it's poised to finally break out again in the near future. And it's also trading 60% below its peaks at 29 times forward earnings and below its 10-year median as well. The company's really well run. It has a nice balance sheet, and overall Wall Street's really high on the stock. So of the 25 brokerage recommendations that we have, 20 are coming in at strong buys with only a couple sells mixed in there. And it's currently trading at 12% below its average Zacks price target. So Lululemon certainly a name to consider as we start July and kick off the second half of 2023. And the last name we're going to look at is Hubbell Incorporated, which trades in the ticker HUBB. So Hubbell is a leading manufacturer of utility and electrical solutions with an established track record that's set to benefit from the critically pressing need for grid modernization and the wave of electrification across the U.S. and around many other places in the world. It's expanding and revamping its electrical grids throughout the United States. Is vital, and many countries around the globe are rolling out more alternative energy sources in the coming decades. So along with the push to have more alternative energy, which is going to require much more building out of the grid, we also need to revamp our aging grid as well. So Hubbell is a more stable, maybe proven way to play the booming growth of segments such as wind and solar and EVs. The company's been in business for 135 years. And it boasts a really solid history of earnings and revenue growth. It splits its business into two major categories of utility and electrical solutions. If you dig a little deeper, its product categories include lighting and controls, wiring and electrical power and utilities, and datacom. So along with its solutions in those spaces, it's going to benefit from the expansion of broadband networks as well. So various other areas outside of wider electrification and grid hardening and stuff like that. So Hubbell grew its adjusted earnings by 70% in the first quarter to top Zacks estimates by 47% on the back of 11% revenue growth. It also boosted its operating margin by 7% to about 19.5% on the back of various improvements in the business and lower raw material costs. Better still, the company provided upbeat guidance to help it land a Zacks ranked number one strong buy right now. And its 2023 consensus earnings estimates up over 23% since its first quarter release, with 2024's figure up about 20%. The current Zacks consensus estimates call for it to post another 30% adjusted earnings growth in 2023 on about 8% higher sales, which would follow 18% sales expansion last year and 14% growth in 2021, alongside double-digit earnings growth as well. It's also set to expand again, both its top and bottom line in 2024, even as it faces that really tough to compete against stretch. And it's beat 17 out of the past 20 periods on the bottom line. And then in terms of its stock price movement, the stock has climbed 850% in the last 20 years with a total return, which includes dividends, of 1,500%. This outpaces the S&P 500's 345% overall. And Hubb's outperformance has remained firmly intact over the last 15 and 5-year time periods as well. And the shares are up 210% in the last 5 years and 80% in the last 12 months. This includes a huge post-earnings release surge, and it's now trading right at new highs again. Last time I looked on Friday, it had hit new highs. Hubbell is trading near the top end of its valuation range with that in mind. When it comes to forward earnings, it's trading at 23 times forward earnings at the moment, but its PEG ratio sits at about 20% below its highs, so it's not too far off its 10-year median as well. The company could see a little bit of a pullback as it is possibly facing some selling pressure in the near term, considering it's sort of overheated on the RSI front. But overall, the company boasts a really sturdy balance sheet that should help it keep boosting its dividend and buybacks. Its dividends yielding about 1.4% at the moment, and it raised its dividend by 7% for the 15th year running in 2022. And as I mentioned, it continues to benefit from the changing energy landscape, electrification, broadband build-out, and more, which are all going to be a big thing for not just the next couple of years, but maybe the next couple of decades. And it is worth noting, I do own Hubbell in the Zacks Alternative Energy Innovators service. So overall, these three stocks are certainly worth considering as we start July and go into the second half of what's been a really bullish 2023. And that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.